What's going on, YouTube? We are officially settled back in from what was an entire first quarter of the year of nonstop traveling, events, just really being up and down all over the place. And it feels good to have been now for the last several weeks, just really plugged into, my home, my routine, my computer, and just really being able to lock into the markets and everything going on. And man, if there's one word that we can honestly say is on everybody's mind when it comes to the type of conditions that we're seeing right now as far as trading goes, is a very infamous word that is either your best friend or your worst enemy when it comes to trading, and that is volatility. Now, when people hear the word volatile or volatility in the markets, they automatically usually associate that with being a negative thing, a bad thing, a thing where basically you're saying it's risky, the market is going to take all my money. But at the end of the day, if you actually want to make money, you need the market to move. And so volatility, all that it's really doing is just increasing the speed at which the market is constantly moving at. So as you mature as a trader and you spend, several months and years into your craft, you start to realize that the right type of volatility is actually our best friend. But we need to understand how to actually harness that power, how to actually, develop trading strategies, systems, concepts that allow us to take advantage of when that volatility is here. And that's why I wanted to make today's video, because we have so much going on in the world of economics as far as what's going on with tariffs, US, China, really the entire global stage is just talking about that magical word, tariffs, tariffs, tariffs. And man, we've seen some movements on the charts, especially when trading NASDAQ, which is basically what I do mainly and what all of my students in our private mentorship do. And so we've definitely seen the effects, especially this last week from basically April 7th to now, April 12th at the time of this recording, where we've had so much up and down news as far as positive, negative, with what we're gonna finally see happen with tariffs. And so personally, I've been trading for the past 7 years almost. Started back in 2018, late September. So we're closing in on year 7. And we've seen some crazy markets in the past as far as COVID, as far as 2022 bear market, but there's really been nothing this volatile I think I've personally ever seen. And so it's really important to be able to adjust and how to actually pivot when it comes to seeing the market, become not just this volatile, but really a little bit indecisive at times, and how to manage your risk through all of that. So looking at news, we've had a lot of different standard financial news events that we usually plan for, such as FOMC, CPI, PPI. We even had some scheduled Trump speaking. But Monday, April 7th was really the catalyst for what ended up happening the rest of the week. And we don't see any typical financial news that shows here on Forex Factory, for example. But what we did get was some interesting back and forth about whether we're going to put a pause for 90 days on global tariffs, and then reinstating those tariffs, and then going back to those conversations about a 90-day pause. And so that back and forth, confusion and decision, whatever you want to call it, about that decision with tariffs is really showing itself when it comes to Monday's price action, where we literally saw NASDAQ swing about 1,700 points. It doesn't even seem real to say that. We had a 1,700 point swing, and that really set the stage again for me when it comes to trading NASDAQ for the entire rest of the week. And the beautiful thing about it is, even though we saw things we've never really seen in the past several years as far as market behavior, we were still able to basically scope out some of the little details, some of the secrets that I apply into market analysis that allows us to basically get a good understanding of where we're going to get those reactions from in the market day in and day out, to really map out a course for buying, selling, and navigating NAS 100 throughout the entire week. So we're going to take a little bit of a deep dive on what are some of the things that we did this week within the private mentorship, as basically a preview to show you guys how we were able to keep tabs on NAS from start to finish, how we were able to adjust our stop losses, risk, and everything to these type of market conditions to ultimately have results. Now, there's 3 main concepts that I use regardless of market conditions as far as understanding the charts and what I'm looking at on the screen but these apply again whether it's a slow market, fast market. And so I've actually made some prior videos on the channel where I break down some of these smart money concepts that you'll see here, such as liquidity, fair value gaps, and supply and demand zones. So we're gonna basically take a look at NAS from Monday through Friday and how we use these three concepts to basically find reactionary zones for us to look for trades. So starting off with Monday, this was a no trade day for me. It just really had a crazy volatility that I was not expecting after New York Stock Exchange opened due to the first news that started coming out about tariffs. But it did set the stage for me to kind of get an idea for what the rest of the week might look like, reacting from how the price behaved during that news. So this is where we start to understand the first concept of liquidity and how it showed itself and how price developed on Monday. So starting from Sunday night heading into Monday morning, we saw the market open and it gapped down an immense amount, from basically dropping over about 1,000 points just from 6 p.m. Eastern until about 7:30. So literally first hour that the market was open on the weekend, we already gapped down a whole 1,000 points. Now from that point, we saw price start to halt during Asia, where we started forming these lows, and as London session started, we saw those lows get respected and start working our way up in price until we had the New York Stock Exchange open, which is at 9:30 a.m. Eastern time. And so when it comes to the concepts of liquidity, we basically want to start to understand where is the money sitting at in the markets, as far as where are some of the, buy orders, sell orders, and how can market makers look to basically take as much money out of the markets to form the moves that they ultimately want to generate later. And so if we start to look at all of the lows that we started forming early New York session, late London session, we start seeing all of these lows that were formed here. And once the stock market opened at 9:30, we saw that first aggressive little dip, basically taking out all of the London session buyers. And that is what catapulted us into that huge price move to the upside. So that is referred to as our sell side liquidity targets. Basically, where are the sell side or the downside targets for where price wanted to manipulate before taking off. Now, I always preach the market is going to do two things. It's going to seek liquidity and or going to rebalance itself. So in this situation, we had pretty evenly balanced price action, and all we really did was take out of these lows before ultimately again spiking up. Now, where did we spike to? That is something interesting to observe as well, and where it went was buy side liquidity targets. The same way the market started taking out the lows early, we started seeing it move towards where we actually had sellers from back on Friday. So we can see on Friday, basically we had all of these sellers pressure the market from these points that we see here. So we're gonna mark up basically the final point of liquidity, which is that first high that forms right here before we start getting that drop. So if we actually start to mark that up, we will see how intentional the market was to get up to that exact point. Again, the point being that on Friday, we had these massive sell-offs and there were people that were still in profit from these sell positions. So as the market goes and rallies upwards, it takes out all of those sellers from the market, basically achieving the objective that it wanted to do. And we know this because of the type of reaction that we get as soon as that objective is completed. If we just rallied thousands of points in the stock market, we just took out sellers from Friday, we see that massive rejection back to the downside. Now, someone may ask, well, man, doesn't it suck to see the market move so much and for us to not take any trades? And of course, you can experience things like FOMO, and you can always look back and do the thought process of I woulda, coulda, shoulda. But at the end of the day, Monday really again left the blueprint for what the market was showing us it wanted to do for the rest of the week. So jumping up to a 15-minute time frame, what we left is something called a supply zone. And my favorite types of ways to see the market generate supply and demand zones is in the form of a wick that takes liquidity and then shifts the direction of the market very aggressively. We talked about the liquidity targets here. We see that this wick on the 15-minute time frame is that catalyst that takes out liquidity before dropping the market drastically. Now, if we mark up that exact wick that we see right here, we will see an area of supply. And I know that the market will do two things. It'll gravitate towards it And once we're in there, we can expect it to push away from it if supply is going to remain in control, which means that we will have sell opportunities the minute we come back up into that specific range. And that's something that we had mapped out, where I actually give projections almost on a daily basis for NASDAQ on my free Telegram channel called Liberty. This is basically a way for the community to get some free insights on how I view NASDAQ, as well as really keep up with me as far as any content or any type of value that I can give before you guys decide to join the private mentorship program. So yes, the links are in the description. You guys can actually tap into this Telegram channel for free, where I'm giving you guys key insights on NASDAQ, again, as well as some other value for you here. And so we can see here that price was actually still around that 17,350 level, basically around here. And we were looking for price to return back up to a little bit over 18,000 price point. So there were some students that took advantage of that and were able to find some long positions, buying up the market until that 18,000 price point. Personally, I wasn't even so interested in trying to ride the buys up there. I was really just focused on looking for price to tap into this area and reject, so we can actually look for sells during New York session on Tuesday. And so again, we had all of that mapped out since the day before, and now we just had to exercise patience, right? Allowing the market to come into our zones where we have a game plan, where we're ready to take action when the time is right. And not only do I give projections, but I will actually show you guys how to execute the right entries at the right time, because on Tuesday, with these projections, we were able to catch a live trade together with the students in the private mentorship, where people were able to take a setup that generated over 3% in profits, basically making triple of whatever you risk. So if you risked 100, you made 300, you risked 1,000, you made 3,000, etc. So this is our back office for the private mentorship called Akashex. And in Akashex, I stream live. I have pre-recorded content that is my most exclusive detailed content. And then I also call out trade alerts or signals, where I'm showing you guys exactly what trades I'm taking with exact entry prices, stop losses, targets, everything you need. So personally, I ended up taking some short positions a little bit higher from where we called this trade, because I had already again been scoped out what NAS was looking to do since the day before. But this was the exact trade alert with my Liberty strategy that I teach in the private mentorship, where we see this before picture basically breaking out of this red box area, and that is where we were able to profit with all the students. As we can see, TP4 was hit for over a 3-to-1 risk to reward ratio. So zooming in here on Tuesday, again, we had this red boxed area, which is part of my signature strategy. We're looking at price basically breaking below this level for us to actually execute our trade. So we go for our shorts here, 500 pip stop loss at that time. And we ran for a little bit over 3%. This trade ended up going for about 3.4, almost 3.5%, but we booked it as a 3% win. Right here, we'll drop down to a 1-minute time frame here to get a little bit more clarity. But essentially, as soon as we got this candle pushing right here below, we executed that trade, ended up running for that 3%. But this trade in this area really, again, all stemmed from our analysis that we did the day before, where we started understanding that this rejection from this liquidity sweep here on Monday was a really big telling sign that the market was going to end up respecting that zone, and we just needed the market to prove that to us. So we did see it tap into the zone pretty aggressively, but the fact that we were not able to cleanly break above it, and we really started to shift structure below and out of that zone, was the first indications of actually seeing this idea work out. So personally, I ended up taking my own positions at around this point right here, breaking below the high point of the range. Ended up calling the trade alert a little bit later, but it all flowed very nicely as price pushed into our next area of interest, which leads us into the next day. Now, this was a 15-minute supply zone that we were looking to basically sell out of. Now we're going to jump up a time frame here to the 30-minute. And on the 30-minute, this is where we started looking at a potential reaction zone for buy opportunities, which again comes in the form of a wick. And this was the wick that really kind of, pushed price down, sweeping liquidity like we talked about, that led to that massive move on Monday. So again, this is all part of the manipulation that we saw in the markets, both on the downside and on the upside that came from that crazy tariff news. So on the 30-minute time frame, again, we can see how this wick basically pushes down and then explodes up in price. So we're gonna mark off that zone as a demand zone. So supply zones are basically wicks that push up before the market comes back down, as we saw on the 15-minute time frame in this example right here. And now on the 30-minute time frame, we do have this wick right here, and we're gonna drag this out throughout Wednesday, and we'll see how price starts to react off of this zone. So again, basically reacting off that supply zone, our projection started to play out, and we were moving into the price zone of 17,000, 16,800 is exactly where that zone started. And again, with the projections, we were looking to react off of that gray boxed demand zone here to push price upwards, as we see here. So we see during Asian session and London session how price tapped into this gray box area and started actually shifting above highs, really breaking towards the upside, which eventually led us to go and push price to where I had really first started looking at targets of basically the highs that ended up being put from the previous day. So back-to-back days, we saw really beautiful projections, and respecting those projections to have some massive trades play out, which eventually that takes us into Thursday's trading day. So again, the concepts of liquidity, and now we start to introduce fair value gaps, right? Concept number 2 that I was talking about. We haven't really talked about that yet in this video, but this is where it starts to really play a factor. So again, as price respected this zone, we started seeing it push up, grab liquidity targets here. And so we ask ourselves, as price continues to rise, where are the next liquidity targets? And so the same way that we saw liquidity in the form of these highs get taken here, we see some more liquidity targets, same exact scenario. We had a bunch of sellers that came in from last Thursday that were still holding their positions from over here. Price pushes very aggressively, taking out all of these Thursday sellers from last week. And we also start to tap into the 1 hour fair value gap that existed from that first massive drop on last Wednesday. Now you can see we already have these fair value gaps marked off with these orange boxes. So we're going to talk about this one and then also this one, as far as why the market reacted to and why it wanted to gravitate towards those two areas. So if we go ahead and extend out that fair value gap here, again, we see how price to end the day ended up tapping into that fair value gap over here after taking out this liquidity. And that's where we started to get reactions from. Now, this is useful information for you to, number one, get an idea of where the market may want to gravitate towards next. And that helps you gain confidence as far as knowing where you can potentially hold your trades. So for example, buying here, not saying you have to hold your full position all the way to here, because we all know that the markets can, give you some profits and then eventually turn around on you. But as far as looking at where can price ultimately get to, and where can I look to maybe hold at least a small portion of my running position, this is where we'd want to get to. So now jumping down to smaller time frames as we head into Thursday's trading day, we see a couple of really interesting key points here that allow us to know where to get into trades and where to hold a trade to next as far as Thursday's trading goes. So we know that when we tap into fair value gaps, we can expect some type of reactions from it. And so the buys that came in from the prior day, we start seeing it kind of run out of gas as we start to head into Asia and then eventually London session. And again, as far as the strategy goes, we look at this red box range that I teach in the private mentorship, and we got some really beautiful reactions during what was London session, where same way that we looked at selling the market, breaking below that low point here on Tuesday, looking to get a move to the downside. Same thing here. We're seeing price basically break the low of this red shaded area, and that is the entry signal to start looking for sell opportunities for NAS. So we start to see again those early sell positions form here during early London session, and then the question is, where can we potentially see those sells get to as the session progresses during New York session? And that is where we start to look at the next fair value gap that was actually this bullish one that came in from the day prior as price had that massive push to the upside. And so we go ahead and also mark off that zone. So again, extending out this fair value gap that we have right here, we see how price basically started moving towards that as New York session starts here. Stock market opens at 9:30. still relatively close to that break of the zone, and we start to move our way down eventually. And a very important thing to understand is not forgetting where we're at as far as the total market structure. What happens a lot in these markets is that people are getting caught up in the small movements in real time, but they lose sight of the bigger picture, which is the narrative that we've seen happen from the beginning of the week, where we had price really drop off from the week before. Early Monday, we get that first real strong impulse to the upside. Price ends up retracing, but respecting the lows of Monday. We end up getting a huge push on Wednesday, which leads to a pullback. So again, people are seeing these massive spikes where we have 1,000 points this way, thousands of points this way, thousands of points this way, and now thousands of points back down. But again, it's just kind of keeping in mind that overall we have been trending upwards. So even though we're looking at sells in this area, we need to be mindful that overall we still are continuing this real big push to the upside, which leads us into the next day that I'll cover here in a second. But this is important to understand because the same way that we can hold targets, when we're buying up, we also need to know when to close out our profits as the market starts to retrace. And so something really important with fair value gaps is understanding where we can get reactions from as far as the fair value gaps range. So if we actually look at the entire range of this fair value gap, basically from where it starts to where it finishes, the midpoint is a very sensitive area that we talked about in the NAS chats in the private community as an area where if you were holding sells, this is where we want to potentially exit those positions, as we could get a reversal from that point. Because again, ultimately we had these highs, we had these lower highs, and then we had new higher highs in the market. So ultimately, this was just one big pullback of this entire move where we would expect some buy pressure to come later. So you don't want to be in a position where if you guys did sell somewhere in this area, you wanted to make sure that you did take your profits at a sensitive point, which is the 50% of this fair value gap right here. And so finally, we start heading into Friday, where again, in the channel, we started looking at price, basically looking to tap into that 50% of the fair value gap, respecting it, and ultimately pushing upwards to break over 19,200, 19,300, continuing the overall bullish push that I just mentioned, where again, we're not losing sight of the overall push that we're getting, but instead we're understanding that this is in fact just a small push to the downside that eventually should come up and take out new highs. So during New York session, we actually see price start to cross back above this high point of our range. Same way that we can sell the downside and catch that move is the same way that we can break the upside and catch that move. Now, as Friday ended, we didn't really get enough volume to really see that trade fully play out to the targets that we had. So market did end up closing on Friday. We will find out now as we head into a brand new trading week, but ultimately, for the most part, every single projection, basically from Tuesday onwards, following this volatility, following this crazy tariff news, kind of gives you the insight of where we can expect reactions from for both selling the market, buying the market, selling the market, and again, buying the market. And so, do we get it right all the time? Absolutely not. Do we hit stop loss? Of course, every single trader does. But there is really not a lot of confusion or fear or anything that leaves people feeling really lost when it comes to analyzing the market because of these concepts that we've been talking about here today. So some other notable adjustments that have to be made throughout the week as far as how we actually execute these setups for me personally was having to use a wider stop loss. So usually I tell people, with the strategy to have a fixed stop loss size, but we've seen that really even after market conditions have had massive ranges that are sometimes 3, even 5 times as large as we've had, let's say a month ago, 2 months ago, really the past 6+ months. So we have to really adjust to that type of volatility with making sure our stop losses kind of match that. And for example, on the last alert that I ended up sending out for sells here, we actually kept the same risk or the same stop loss size that I usually use in normal conditions anyways, and it worked out. But to give you an idea, we ended up taking shorts here, and if we look at how small a 500 pip stop loss looks like in this type of market, it looks silly to even use that small of a stop loss. But again, that's something that we've been using for many months straight, like over a year plus, as the community has traded this strategy. And we haven't really seen a market this consistently be this volatile to where our stop losses look like we're micro scalping. So I bring that to attention because, for example, if we, adjust the same way that we see the volatility go up 3 to 5 times with a stop loss, for example, 3 times the size, we're still able to catch a big move that can get us over 6R. So even though we're increasing our stop loss, let's say triple the size in this type of scenario, we're still able to bag the right risk to reward. And that's what I want to end the video with here. It's not just understanding concepts such as liquidity, imbalance, fair value gaps, etc. It's about understanding the elements of making a trade worthwhile. And so some people's accounts just cannot handle trading with over 1,000 pip stop losses. I'm well aware of that. Usually most of the students in the private mentorship are trading funded accounts. And when you have an account, even like a 25K, a 50K, you can afford to really have 1,000 plus pip stop losses. Something small like a 10K prop firm challenge account or maybe a small personal account, quite frankly, cannot really handle these type of conditions right now as far as a conservative risk approach. If you're looking to, again, be a little bit more slow stepping, you're not looking to be so aggressive, but it doesn't mean that you can't trade overall. It just means that something like NASDAQ specifically, you might need to shy away from for a little bit if your account can't handle it. Or again, just look to increase your funded account options. So we do have really great promotions right now. Shout out to TradexMastery, our official partners for the prop firm space. You guys can actually get some discount codes to get 40% off your funded challenges if you hit the link below, because that's what we're really using right now to take advantage of these market conditions. We're looking at setups together and we're able to adjust our risk to really have, again, much wider stop losses without sacrificing the risk to reward element. At the end of the day, when we have those conditions where the market was a little bit slower, 3 months ago, 6 months ago, the 500 pip stop loss was something that we had as a constant, and it's been working overall amazingly. And even though we're still able to use that now, we do have to be mindful, for example, that 500 pip stop loss might actually get disrespected a few times. So how we combat that is really 2 different ways. Number one, we can either look to basically take on a much smaller risk percentage per trade, knowing that our stop loss can get hit a couple more times than usual because it is so tight, and then ultimately take advantage of the risk to reward factor that comes from that. To give you an idea of what I mean, a 500 pip stop loss in this same scenario from Monday's volatility, again, looks ridiculous how small a 500 pip stop loss looks here, but it had an ultimate push of about a 26R trade. Now, I'm not somebody that looks to micro scalp and take 10 to 1s, 20 to 1s, even though there are some traders that use those type of systems. What I tell people is that if you have a system that gives you a crazy R to R, then naturally the counterpoint to it is that you're going to have a much smaller win rate, right? You're going to take more stop losses trading with a tight stop loss. So again, if you're going to keep, for example, those same size stop losses whenever the volatility goes up, if you have a fixed stop loss system, you might need to just understand that you're going to take a lot more stop losses than usual because of that. And so if you minimize your risk percentage per trade setup to account for more stop losses being hit, then that's one way to mitigate the risk. The second type of way, again, is just tripling up, quadrupling up your stop loss size, for example. And basically to be able to give the market some time to have that ebb and flow where we might get into drawdown and out of drawdown a few times before ultimately the overall direction we expect to play out ends up playing out. So let's see how much longer this type of volatility lasts in the markets. I'm not scared of it. Honestly, I do welcome it, especially now that we kind of understand that this might be the norm for the time being. But regardless, that's what being a trader is about. You have to be able to adapt, respond to whatever the market is showing us, and not get caught up in the same mentality or thought processes that we may have had in a different time, in a different era of the markets. So if you are somebody that feels a little bit lost or even fearful to trade in these type of conditions, I think ultimately what you need is the right type of guidance and community to help you really understand how to navigate these times. So if you're not already a part of the private mentorship with Akashics, make sure you hit the links below to get plugged into our private chats, into our live sessions, into our trade alerts, so that you guys can take advantage of what is going on right now. But with that said, hope you enjoyed the video. Hope you guys found some value. Please make sure to like, comment, subscribe, turn on those post notifications so you never miss another video from me. And as always, let's run it up.